You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Challenge us at Wexford Insurances 0818 31 30 30.
After last Wednesday night's event in the Riverside Park Hotel, I had the opportunity of speaking to Conor Sweeney of Hughes Blake Chartered Accountants, where we discussed the 10 commandments of running a business, and this is what he had to say.
Yeah, I suppose the 10 commandments are for anyone who's considering to become a director or is a director of a company. And what we have is we have 16 Companies Acts, which make up about 100 or 1,300 sections of company law that require directors' knowledge and make sure that they comply with these provisions. So what we tried to do this evening is take out the 10 key company law commandments that directors should be aware of. Because me as a company law expert, my knowledge of company law is quite in-depth, but for someone who's just starting a business, won't have that expertise. I don't know too many people. I think I've met one person who's become a director and read the Companies Acts in total. So it's up to us, and the idea today was to address some of the 10 key commandments that directors will keep them compliant in their company.
What's number one?
Number one is act honestly and responsibly and in the best interest of their company. So that's very simple. You know, act in the best interest of your company, not the best interest of yourself or the wife or whoever. You're going to act in the best interest of this company because it had creditors. It's a separate entity from the directors, so they have to act in that best interest.
And how is it proved by, let's say, the Director of Corporate Enforcement that somebody wouldn't be acting honestly?
What happens is if the company unfortunately goes into liquidation, a liquidator is job is to go in and look at that company and look to see what happened. It doesn't apply 20/20 vision, but what it does is it looks at the activities of directors over the period of that company and to see what key decisions were made and apply a test of acting honestly and responsibly and whether at that time did they act honestly and responsibly. If they did, directors have nothing to fear. It's the guys that didn't act honestly and responsibly, were taking assets out of the company or using the company assets for their own personal benefit. They're the guys that will face the likes of restriction or disqualification proceedings.
You've seen lots and lots of companies over the last number of years through your position within Hughes Blake. Give me some general examples of where you've seen business owners, let's say, unintentionally operating illegally or dishonestly.
Sure. I suppose one of the key issues that we see is in relation to directors' loans. One of the commandments we mentioned is that directors shouldn't breach the rules in relation to directors' loans. That means you cannot take more than 10% of a loan from the company. That's above 10% of the relevant assets of the company. And that's something often directors are not aware of, and then they breach that, and that's something that their accountant or their auditor is required to report to Director of Corporate Enforcement. And if that money isn't paid back, then it becomes an issue for those directors if it went into liquidation. So there's one area, using money owed to the revenue commissioners to continue to trade instead of paying that money over to the revenue commissioners. Another area that we often see, using the funds, using the assets of the company for their own personal gain, where they're using the assets belonging to the company, but the money that they earn from using those assets doesn't go into the company, it goes to them personally. So there are some of the key areas that we see.
What are the consequences, let's say for instance, if upon a liquidation that a liquidator did identify that somebody was operating dishonestly within the business itself?
Well, the main thing that directors may face if a company goes into liquidation is a thing called restriction. Okay, and if you're restricted under the Companies Acts, it means you cannot act as a director or a company secretary for a company for a period of the restriction, which is typically 5 years, unless you've paid up a share capital. So you put in share capital into the company of 63,000 for a private limited company. So it's restrictive in its nature. You pay up the money and you continue to act as a director. If you're disqualified, and typically where that happens is if the company is struck off the register, typically for failing to file an annual return, which is required to do every year, then you could be disqualified. If you're disqualified, you cannot act as a director or secretary or even manage a company. So even if you're not an officer, even if you're the sales manager of a company, you couldn't even take up that position. So it can be quite onerous on directors if they are disqualified. So they're the kind of areas that we see directors and the consequences that they come across.
Let's go back to the commandments. I know
Sure.
we've covered 3 or 4 now in the last couple of minutes.
Sure.
What's next?
Well, the second one, and probably a very key important one, is keeping proper books and records. Okay, that's something that should be the forefront of anyone running a business, be it a company or be it a sole trader, but having financial information that's fully up to date. Okay, and having that readily at hand and kept up to date is important. It's one of the ways of being found personally liable for directors if they don't keep our proper books and records, and that has led to the company to go into liquidation and debts not being recovered. So that's the second one. Third one is preparing annual accounts. So one thing you're required to do is keep proper books and records, but every year a company has to prepare annual accounts. If they have filed late, then they have to have an audit done. If they're under the audit exemption thresholds of 4.4 of a balance sheet turnover or a balance sheet total and 8.8 million of a turnover, then they're audit exempt. So they don't have to have the cost of having an audit done, which is a huge advantage and a huge cost saving to companies. But they do need to make sure those annual accounts are prepared. The next one is to file their annual return at the company registration office. So your annual accounts are prepared and signed by the directors. They must then be filed in the company registration office. That is one way companies get struck off the register, is that they don't file on time, and that incurs late filing penalties. It means an audit has to be done, which is a significant cost, and if they continue maybe a year after their annual return date and they haven't filed, the company can be struck off the register, and that is where personal liability can also come in for the directors if they continue to trade, and we have seen instances of those cases.
Round about filing covered, is there anything else under the filing aspect that we should discuss before we move on? Because filing is quite an important aspect of running a business today.
It is, yeah. There is a number of obligations. You have a revenue obligation, but filing the annual return is key. It's making sure that that's filed on time and being aware of their annual return date and making sure you file within 28 days of annual return date at the company registration office is a key point. And that's something you can look after yourself. You know, you can log on to the company registration office website and they have a core, which is a very useful system where you can see your annual return date, print it off, sign it by the directors and file it with your financial statements. Finally, just in relation to filing, one of the key issues if you're filing your annual return is to see has there been any changes in your company during the course of the year. So has there been changes in directors, has there been a change in the company secretary, the registered office, and a particular interest is has there been any change in the shareholders. So have there been new shareholders introduced, have shareholders left the company and maybe shares have been transferred. And it's important to make sure first of all that documentation was done correctly. So they need to make sure that the correct decisions were made by the directors or the members and they were approved and the appropriate forms filed at the company registration office, but also then that annual return that you file reflects those changes.
We'll move on from filings to meetings. Larger companies, we're all aware of them out there, they have board meetings monthly. Now, 90% of the businesses across County Wexford, those owners of those businesses that will be listening to this show, certainly, I would say in most cases, don't hold regular meetings.
Sure.
How important is it for them to hold regular board meetings?
I think in the current environment it's very important. Just like you said, everyone's aware of the big companies hold their directors' meetings monthly or whenever, and they hold their annual general meeting every year. The same obligation is required in relation to small companies, believe it or not, but unfortunately it is a requirement. Typically for a company, they normally do two things every year. If they don't do anything else in the course of a year, one thing we just mentioned is they approve and sign their annual accounts. So that has to be recorded as a meeting. So if you'd only have one directors meeting every year, it's your board meeting to approve and sign your accounts. What we always advise our clients is if you do anything that's not part of the normal course of business, you should hold a directors meeting and record that decision.
Why is that so important?
The important is, we mentioned earlier on, if the company faces financial difficulty, if you're trying to prove as the directors of the board that they acted honestly and responsibly, how do you remember what you decided 3 years ago? How can you prove to an independent liquidator that you were acting in the best interest of the company? So your minutes are your prima facie evidence of a decision made at that date. If legal proceedings are going to be brought against the company and you're trying to go to court to prove you made certain decisions that are in the best interest of the company, your minutes are your key record, and it's the legal record of what decisions and the legal capacity of that company.
Apart from your regular board meetings, there's also a requirement to have an annual general meeting.
Yes, that's correct. I think a lot of people were probably familiar with annual general meetings if they're part of a club or an association, but one of the requirements of private limited companies is that they hold an AGM every year. So this is where the distinction between directors and members, even though they might be the same people, they're also required as members to receive and consider the accounts. Okay, and that's something companies are quite good at meeting and approving the accounts, but sometimes they forget that they also should hold an AGM. Now, one useful thing that's coming out in the new companies bill that should be here in the end of 2014 is it's removing the requirement to hold an annual general meeting. for companies limited by shares. But unfortunately, we're at least a year or two away from that new legislation coming in. But that should cut a little bit of red tape for companies. But up until then, we still have to hold an annual general meeting every year.
That impending bill also has implications for group-type companies.
Yes, it does. In relation to groups, at the moment, a company can avail of audit exemption if it is under the audit exemption thresholds. However, if it's in a group, so if one company owns another company, it cannot avail of audit exemption, even if it's under the thresholds. So something we welcome is the fact that you can put a company into a group, and the advantage of that is you can give loans between the two companies without breaching the company law rules we mentioned earlier on. And that has a useful aspect to it, that they can still avail of audit exemption if it's under those thresholds. So it's something to be welcomed, and it'll cut costs for companies.
That's good news. Back to the commandments. What have we left?
Probably the key one, two last ones that we mentioned are in relation to transactions in relation to directors. And the two ones I want to highlight here are in relation to directors' loans that we touched on briefly, and also transactions with directors. The main one is in relation to directors' loans. You cannot take a loan out of a company that's in excess of 10% of the relevant assets. So just be careful.
Just explain relevant assets.
Okay, relevant assets are your gross assets. So when you prepare your balance sheet, you need to see what your gross assets are. And if a loan is in excess of 10% of your gross assets, then the directors are in breach. Now, an advantage in relation to the bill is that you have 2 months to rectify that, to repay the loan. Otherwise, the company is in breach. That is something that is required to be, if it's an audited company, it's required to be reported to the Director of Corporate Enforcement. If it's an audit exempt company, your accountant isn't required to report. But as I said, it still is a breach of company law. So yes, the director's loan is probably the most common one that we do come across. And what we try to explain to directors is it's not 10% of the cash in the balance sheet, it's 10% of your total assets. So what you're looking at here is your value in your buildings and your gross assets in relation to your company. So it is important to make sure, if you're taking a loan out of the company, and a loan doesn't mean to say I'm taking, 50 grand out of the company today. It could be using the company credit card, taking the money out every week, and that just builds up, and you mightn't realise until you prepare your annual accounts the following year that you've breached it and you've missed the 2 months in which to rectify it. So it brings us back to our point about keeping up-to-date books and records, knowing monthly what your assets and liabilities are, and monitoring your director loan. It doesn't say that, company law doesn't stop you taking the loan out, it just needs to make sure that you don't breach the rules in relation to it. The other area that we see is in relation to directors' transactions. So if a company is buying or selling an asset from a director, an approval might have to be obtained by the company beforehand. So it just regulates those transactions. So there are things that you might want to get some advice on if you're buying or selling assets by the director with the company.
Conor, I have a question for you in relation to contracts. Let's say, for instance, an owner of a number of different companies has provided services through the other companies into one company. What is the situation there from an obligation perspective under company law?
In relation to directors' disclosure in contracts, a director is required to disclose his interest in any contract at the first meeting he becomes aware he's going to be a director. So, in argument's sake, if I have a cleaning company and I'm also director of a hotel, and the hotel decides at a board meeting we're going to outsource the cleaning, me as a director of the hotel will have to disclose that at the first board meeting of the hotel, and also at the first director a meeting of my cleaning company I will have to disclose that. You then need to check your articles of association, which are the rules in relation to a company must comply with, to see can you vote in favour of that contract. So in some articles you are allowed to vote in favour of it once you've disclosed it. However, if other articles of association provide that you can't vote, and if you did vote in favour of it, the contract may be deemed to be null and void. So that could be a contract that a liquidator might try and set aside if it's maybe above market value or something to that effect. So the key thing for directors is, if you're interested in a proposed contract, first of all check, are you interested in it, and then disclose that at that meeting and check to see whether you can vote in favour of it. Okay. But that comes back to making sure and reading the rules and regulations in relation to your company and your memorandum and articles of association, and also if you're unsure, just take some appropriate advice in relation to it. That
leads us to the final commandment.
Final commandment, yeah, one of the final 10th commandment, and that is in relation to insolvent companies. Companies are in financial difficulty, and a question we often get is, when do I decide to pull the plug? What is the obligation under the Companies Act to say enough is enough? Under company law, there's 2 solvency tests. It asks you, first of all, are you solvent on your balance sheet, which most people can see if they do upward profit and loss and balance sheet. They can see, well, actually our balance sheet is insolvent and we have a duty to wind up. What a courts kind of look at a little bit more is to see, can you pay your debts? So are you able to discharge your debts reasonably incurred as and when they fall due? And if you can't, and you do that over a period of time, and you can't pay your debts and discharge your debts as and when they fall due, then the company is insolvent and the directors need to take steps to wind up the company. Now, directors, that doesn't mean to say you pull the plug straight away. What it means is directors need to meet as a board, review the financial position of the company, but they could have just gone to tender or part of a tendering process for a new contract. That contract might take 3 months. So directors could have a board meeting today saying, listen, we know we're insolvent, we've informed our creditors, we're going to wait to see do we win this contract, because if we win this contract, we're going to have to hire 10 staff. So it is prudent on the company, if it's insolvent, to act in the best interest of its creditors. And in that situation, the best interest of its creditors is to wait the 3 months, see if we win the contract. If we win the contract, they get everything. Whereas if they don't, after 3 months, then they need to take the steps to wind up the company. 2 key points in relation to that is, 1, hold a meeting, take the proper advice, document the decision that they're making and keep their creditor informed.
You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Think Wexford Insurances for your business insurance.